On April 27th, when Enphase Energy stock was at $167 per share, I posted a video wondering if this was the best growth stock to own now in the after hours. After reporting their earnings after the bell, which beat expectations, Enphase Energy stock is now $236 per share. We'll talk about, are the best days for Enphase behind it, or is this going to continue to be a stock that outperforms the market in a major way? What is going on, investors? Hopefully you guys are doing well out there. Look, when you say a stock back in April is going to be a great growth stock and the stock market basically sells off since then, and Enphase Energy over the last 6 months is up 77%, that's certainly going to get my attention. And when we go through these earnings, it's going to get your attention. Take a look at those Q2 earnings that came over at Enphase Energy. Revenue coming in at $530 million. That was 67.8% growth year over year. Expectations were closer to $500 million, as this company beat those expectations by nearly $25 million. I think there's a lot of impressive things here, but the Q3 guidance as well. Again, we'll walk through the Q2. Folks, there are some really nice things here from a financial perspective. I'll show you every inch of that, but I do want to talk about Q3 guidance over at Enphase Energy coming in at $590 million all the way up to potentially $630 million. The consensus estimate before this guidance was put out was closer to $550 million. So quarter over quarter, they're expected to go from 530 potentially all the way up to 630. Wall Street was expecting closer to 550. When we come over here to the analyst estimates, revenue growth in the upcoming quarter was only be 56%. Now it's going to be well north of 60%. It starts to make us think, well, what the heck is Q4 going to be? Analysts are expecting that to be 42% growth at just $588 million, when in the upcoming quarter, they're expected to do as much as $630. And on the low end, they're expected to come in where analysts had them projected for Q4. You start looking out with this company. Well, if it keeps accelerating this revenue growth, well, yeah, this stock is probably going to continue to rocket higher. Now, when we come over here to look at these financials, I tell you what, over the history of the show, we've watched numerous companies blow up their revenue 70, 80, 100%. The Zoom videos, the Teladocs, the Coinbases, the Palantirs, number of different companies boost these revenues, and it looks amazing on paper, but they don't follow that up because they blow up sales and marketing spend, and they rain down on executives and employees excessive stock-based compensation. Cough, cough, Jack Dorsey over at Twitter, and now his time at Block. That is not the case over at Enphase. That is why I can post a video when there was all these fantastic growth stocks that everybody was pumping down your throat. The one that maybe there's a couple of them that I pointed out, and some of them probably didn't work out, but this one is a glorious example because of what they've done on the cost side. I'll show you that in a second, but from a net revenue perspective, we went from $440 million up over $90 million to $530 million. Now, one thing that we glossed over because there's so much to like here is our gross margin. Folks, it gets better and better and better. Our gross margins went from 38% up 3 basis points to 41%. So they have accelerating revenue. I'll show you they have accelerating earnings from an operating and a net income perspective, and they have accelerating margins. This just gets better and better and better. So our total cost of revenues didn't outpace our revenues. So we have increasing gross profit over at Enphase from 177 up to about $219 million. Again, a $530 million worth of revenue, gross profit of $219 is absolutely fantastic. But look what they do down here on the operating expenses. Research and development up just from $35 million to nearly $40 million, a gain of less than $4 million. Selling and marketing. Look, when you grow your revenues this much by over 67%, and you're factoring in growth in the upcoming quarter that far outpaced expectations over at Enphase. Well, you'd expect sales and marketing to get goosed up, but it looks like this company's products simply just sell themselves. Notice you went from 41 million up to just 53. And probably the most impressive thing over at Enphase, look, these guys could be flying around in private jets and blowing lots of money on that G&A side, but those costs actually went down, believe it or not, from 38 million down to $32 million. They're doing a wonderful job controlling cost over at this company. Look at our total operating expenses up from just 115 to 124, folks. That is less than a $9 million increase on operating expenses when you increased your revenues tenfold over that. So you increased your revenues by 90 million. You increased your gross profit by nearly 40 million, and your operating expenses went up just $9 million. Yeah, your income from operation is going to absolutely blow up from $61 million, and I thought that was fantastic, to an impressive $94 million. So a $530 million worth of net revenues, $219 million worth of gross profit. Almost half of that gross profit flows down to income from operations. It just gets better and better and better. Now we pay some interest expense and some income taxes, and we flow all the way down to net income in the quarter at $77 million. Last year, we were at an impressive $51 million. It holds true for the 6 months off of $971 million worth of revenue 6 months. You have $128 million worth of net income. Folks, when you're looking at companies, and we're not talking about the Googles and the Microsofts and the Apples and even like the Metas and even stocks like Netflix, where you'd expect profits and revenues to these types of degrees. And Enphase Energy, quite frankly, is flying under the radar, and I have no idea why, because those are some of the best financials I have ever seen. Now, in terms of the assets on the balance sheet, it gets even better. We've got plenty of cash over here, and come down here all the way to total liabilities at this company at just $1.9 billion. They have almost that in cash. They might even have that in cash. Well, they have total current assets at 1.7, total assets at 2.4. Some of this has to do, you've got some inventory over at this company, but when you're growing your revenues this fast, they probably wish they might even had more revenue. You've got a clean, crystal clean balance sheet. You've got very, very disciplined cost controls over at this company. Almost like they're projecting this run rate in terms of this growth rate to start to stall out. And that would be somewhat disappointing as an investor. So we have to factor that in, that maybe the 50-60% growth rate is at some point we're going to run into very tough comps and tough growth rates. But when you're running the company this well, there's still a lot of investors that will simply stay on board. And then when you flow down here to cash flows, we pull down a 3-month number. Again, we're pulling down a really impressive $77 million worth of net income. Last year was like $25 million lower at $51 million. And look at our net cash provided by operating activities. It doubled over the last year. It went from $102 million, nearly doubled, to $200 million. Are you kidding me? For the last 6 months, they had $303 million and just $200 million in the quarter. It just gets unbelievable. They didn't do anything on the financing side. Yeah, they had these proceeds from an equity award to executives, but it was just $4.1 million. This company produced $200 million worth of cash flow off of $77 million worth of net income, and the executives paid themselves $4.2 million in equity awards. I don't know. Maybe I should be their agent. I think they should be getting paid more for this. This is either how every company should be run in the stock market, or this is such a shining and different example. This is the reason why the stock has just rocketed up. Quite frankly, the average investor probably not investing in a stock like this, but institutions are looking at those types of financials and they're great. Now, from a technical perspective, things are glorious, okay? This is what we're looking, and look, we might be late on Enphase at this point, okay? If you didn't get back in on April or any time in between now and then, might be a little bit late, might not want to buy it at these levels, but we'll talk about this, okay? This is kind of what we're looking for with all the major tech stocks, okay? A lot of these tech stocks peaked out here back in November of 2021, just like this stock, and then put up a bunch of red candles, okay? That almost looks like the Nvidia chart, certainly looks like Facebook and Netflix. These stocks have absolutely fallen off a cliff. What are you looking for from a reversal perspective? You start chopping up with higher lows and you start chopping up with higher highs. And then on top of that, you're breaking through key areas of resistance. Previous at 169, right here, there was a pretty clear area right at 200, and boom, we chopped out right over that. If you just can't get enough of Enphase and you want this one, I think we pull back and retest 200 at some point. That would be a natural spot from a technical perspective. Even if this one has a monster rally, gets up here into 240, we'd expect some red candles to show up on this uptrend. Again, when you're in an uptrend, you can buy the dip, okay? Understand that this uptrend is pretty well extended. It is supported by the fundamentals though, and if you believe that Enphase is sandbagging a little bit, and on top of that, maybe there's this secular trend to move to more solar and renewable type energy, which would be a massive tailwind for this company as they clearly have a market-leading product inside that market. You do buy the dips when stocks get in these uptrends. I mean, this is a pretty steep uptrend, okay? This started back in January, and it looks like the chart of oil, quite frankly. It just continues to chop up. So this not only applies to Enphase, we do not buy the dips on the way down, especially right in the beginning, and even the first sign of a comeback. We don't usually step in there and buy the dips unless it's some kind of shorter term trade. You want to wait for this one to start making this type of uptrend, because look, with Enphase, you didn't have to get this one at the bottom back in January at 116. You could have waited until it clearly started making some lower highs. Look, you could have bought it back in May for 157. You could have bought it again back in June for 172. Shoot, you could have bought it earlier this month for 185, and you still would be doing good. So don't feel like you need to rush back into these stocks. They can form these uptrends. We can buy the dips on these. I wouldn't necessarily buy it right now. Enphase is basically kind of in the middle of its uptrend. I, quite frankly, would wait till it gets to the top of this channel, makes a retracement. I think the obvious place is right here at $200 per share. You have the benefit of it being an area of support and resistance in the past. And on top of that, it'll probably coincide with the higher low trend that we're making here with this green line. If those two lines come close to converging, that would be where I step in. At the same time, considering this can be a volatile stock, it's been as high as $280, $290 per share, and it's been as low as about 117. I'd probably set a stop loss on this one. If I bought it at 2, I'd have a stop down here at 180, maybe the low end down here at about 165. You can buy the dips of an uptrend. You do not buy the dips of a downtrend, because you could have bought the dips all the way along here on Enphase. Unless you really heavily bought them down here, you would just be getting back to break even, where if you bought the dips on the uptrend, you're guaranteed to have made profit even up into last week. That is why we looked at Enphase today. Many things line up with all of the other stocks. So even if you missed Enphase, apply what you learned here to every other stock that you're looking at. You're looking for a reversal in trend in an uptrend. You're buying the dips in an uptrend. Doesn't matter really, quite frankly, what stock you're looking at. But if the fundamentals support it, where you've got an unbelievable balance sheet here, where on total current assets, it almost meets all of their liabilities. This company is growing their cash flows, growing their revenues, and they're increasing their margins at the same time. Everything that Enphase is doing, quite frankly, is impressive. That's why back in April, we called this one of the best growth stocks to own at the current time. And in the after hours, up nearly 9% to $236 per share. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.